Community banks play a critical role in our financial system. As a lead federal supervisor for the majority of community banks in the United States, the FDIC has a particular responsibility for the future of these institutions. In 2012, the FDIC began a series of community bank initiatives. The FDIC Community Banking Study, released at the end of that year, was the first comprehensive review of the role of community banks in the U.S. financial system. That study made a number of important findings that have since served as the foundation of our work. First, the study found that although community banks account for only 14% of the banking assets in the United States, they hold 45% of all the small loans to businesses and farms by banks in our country. In other words, community banks play a critical and not easily replicable role in small business lending, essential to the U.S. economy. Second, the study found that if not for community banks, approximately 20% of the counties in the United States would have no bank at all. And third, the study found that the community bank business model, careful relationship lending, funded by stable core deposits, focused on a local geographic area well understood by the bank, held up exceptionally well even during the stress of the recent financial crisis and ensuing recession. Based on these findings, the FDIC has undertaken a series of additional initiatives to provide assistance to community banks. The FDIC has developed a series of more than 20 videos available on the FDIC website to provide easily accessible technical assistance to community banks. The videos focus on important risk management and compliance supervision issues, such as interest rate risk, new mortgage lending rules, and the responsibilities of bank directors. The FDIC developed and distributed Cyber Challenge, a community bank cyber exercise, to all FDIC-supervised banks. Cyber Challenge provides operational risk-related scenarios and challenge questions designed to facilitate discussion and allow community banks to assess their preparedness for and response to cyber-related events. The FDIC expanded its reporting in the FDIC Quarterly Banking Profile to include a new section on community bank performance in order to enhance community bank and financial market understanding of the performance of community banks. The FDIC has also recently released studies on bank consolidation, bank branching, and minority depository institutions of direct relevance to community banks. Finally, through its supervision of community banks, the FDIC continues to look for ways to make regulatory compliance more effective, efficient, and less costly in recognition of the often less complex and less risky activities engaged in by community banks. The FDIC, through its community bank initiatives, has contributed significantly to enhanced understanding of the importance of community banks and to assisting them in carrying out their important role in the financial system. Community banks will continue to be a top priority for the FDIC going forward.